So before we dive in, let me quickly walk you through what we'll be discussing in our latest edition of Netra. First up, we'll explore the boom and bust cycle, a reminder that what goes up must eventually come down and the other way around too. Next, we'll talk about how tough it is to find bargains in today's market. Then, we'll revisit the unsettling calm of low volatility. So if you've been keeping up with our previous reports of Netra, you'll know this is something we've been consistently talking about and watching closely. This time, we've got more data that highlights why this calm feels just a little too good to be true. We'll also take a look at large caps and whether they might be an opportunity right now. After that, we'll touch on how the India growth story, which has been riding on strong capex, might not hold as much substance in the current context as one might think. Finally, we'll discuss India's consumption cycle. While it has jumped ranks globally, when we look at it in isolation compared to its own historical numbers, the picture is not as rosy as we'd like. Thank you so much again. Let's get started. Over to you, Sahil.
Thank you, Pragati, and thank you everyone for joining another DSP Netra webinar. And I will get going with the presentation. Pragati has already, spoken about the flow, and let me possibly tell you one more time, a brief about DSP Netra. So as all of you know, DSP Netra is a monthly report that we release on 5th of every month. And our goal with this report is to provide you with early signals through visually engaging data. And we believe that by presenting facts and data in a clear and concise manner, we can help you make more informed investment decisions. It's important to note that DSP Netra does not provide any forecast. We are not attempting to predict anything. It is beyond our capacity to predict trends or see into the future. That most likely could be an astrologer's job. Instead, we focus on identifying areas that are reaching an extreme or may soon reach an extreme based on historical data. These are the areas that we believe deserve your attention. And the August edition of Netra, as Pragati has highlighted the flow, I will tell you that there are just about 4 key points that we want to make today. First is the boom and bust cycle, and in which we will explore the non-linearity of financial markets. Second will be valuations, breadth of valuations, and of course the unsettling calm, the phrase that we have used. And in this segment, we'll delve into the historical context of valuations, market breadth, and currently the low vol scenario that we've seen. Third, we'll talk about the large cap space and why we think that it is a relatively better space to be. Fourth, we will talk about the interplay between capex and consumption. So we will showcase to you 2 trackers on how to look at both capex and what is the interplay between each one of them. How consumption cycle and capex cycle is linked. That will be the last part of our report today. But first, there has been a ramp up spike in volatility over the last 7 days, specifically starting from Monday, where Japanese market fell quite a lot. So I will try to address those issues first, and also maybe give you a small market outlook in terms of what has transpired over the last 7 days. So with this background, we'll start. So first, we will start about and talk about this badly beaten narrative of the yen carry trade. Although I never wanted to address it, but I think it's been addressed quite a lot, and all of you understand what it is. But there was a lot of nervousness, specifically last week when market became volatile, and the Japanese market was the main source. Japanese Nikkei is now roughly down about 23 to 25% from the peak, and it had a single day decline of 12% on Monday, which was very large, sort of a Black Monday of its own for Japan. And almost everyone agreed that it was because of the yen carry trade unwind. And maybe it was, I'm not very sure, although I may disagree as well, but let's assume that it was, right? And first, take a look at your screen. This chart that is there on your screen, it showcases, how rate differentials have moved between United States and Japan. So two of the markets where a lot of people are now talking about the yen carry trade. So when you see these two lines going up, what are these lines? These are the differential between rates available in US fixed income market versus the Japan call rate. And this is the difference. As you can see at this point in time, the differential is close to a 25-year high, right? And this means that this is a time where the yen carry trade becomes the most lucrative, not the least lucrative, which is what a lot of articles and other stuff is talking about, that a 25 to 30 bips decline in this lucrative spread has caused all the volatility in the world. And if you look at it very closely, the numbers were very, very extraordinary small just about a few years ago. And I'll come to this important topic, but let me first tell you what the yen carry trade is. Right? So, what is yen carry trade? So you would have already read dozens of articles. As I said, a lot of people wrote about it. But simply put, it's yen carry trade, or any carry trade is to borrow money cheaply and then invest it in an asset which yields higher returns. So let's, for example, borrow Japanese yen at 50 basis points because it is cheaper to borrow in Japan, and then invest, let's say, in US Treasury at 5%. So the differential is what you are expected to make given the currency remains stable, right? That is the carry trade. In fact, carry trade is just another name for investing, right? We do it all the time, right? We are doing the same thing. If we invest our cash, which is the low yielding asset, into, for example, equity, which is a high yielding asset, it is nothing but a carry trade itself. So it is just a financial mumbo jumbo for the same simple thing of investing or trading, whatever you call it, and there is no difference. Second thing is, you are just profiting from low carry currency to a high carry currency or an asset. So the yen carry trade, specifically refers to Japan because people are borrowing money there. And the reason it refers to Japan is because Japan has kept its rates close to 0% for about 30 years now. And it's very cheap to borrow there. So a lot of investors typically borrow through either financial institutions or using financial instruments like swaps, right? Where their liabilities are denominated in yen and their assets, which they buy, are denominated in either USD or Euro, depending on which carry trade we are talking about, right? So this is a simple idea. Borrow money and keep your liability in yen, and then try and seek assets which can appreciate higher and give you high returns in other currencies. So that, given that if yen doesn't move a lot, or if yen doesn't appreciate, your returns will be quite significant, right? If yen were to depreciate, uh, returns for carry traders will be even higher, right? So that is how it works. And now back to the chart that we were discussing. If you look at it, as I said, currently the yields to enter into a carry are one of the most lucrative that we've seen, not at a point where there needs to be an unwind, right? And if you look at it carefully, just about 2 years ago, the yields between, or yield differential between US and Japan was close to 0% because both had cut rates to 0%. And that was a time where the yen carry trade should have unwound, or maybe it already did unwind at that point in time. But if you remember very carefully, that was the exact time when the global markets rallied after falling during COVID. They actually went up, which means that this hypothesis that an unwind can cause global markets to melt down is easily falsifiable by if you just look at the past data, right? Which means that yen carry trade is not carry trade, or any other carry trade is not the only game in town. There are many other levers, many other factors which can influence the movement of market, and this is one of them, not the only thing which is going to influence the movement of the market, right? Then what is bothering the market? I'll give you my theory, right? So here is what I think. The global economy, I think, is right now fractured. US economy has done very well. Half of Eurozone is in recession. China China is slowing and it's unable to recover and stage a strong recovery. India is growing steadily. Latin America is struggling. So when you look at the globe, it's very fractured. There is no synchronous growth. For example, like it happened in 2000 to 2008 cycle, where all countries were growing together. Right now, it's very, very fractured. US being the largest economy and which is growing, and it is also the key driver of global equity returns at this point in time. Highest earnings growth, one of the best equity returns, and also growth, which I just spoke about, economic growth, is resident in United States as of now, right? With the size that it has. Any risk to the growth in United States is a cause of worry. And why is it a cause of worry? Because it can hit corporate earnings very badly. Corporate earnings growth has been steady. If there is any nervousness with rate which relates to growth slowing down in US, it can hit corporate earnings growth. That I think is what is causing nervousness in the market. And one of the key architects of that nervousness was, a reduction in US payrolls. Where we saw uh, the US job growth or non-farm payroll data beginning to reduce. That was, I think, one point which caused certain amount of nervousness in the market. And why that nervousness? Because when you look at the US economy, uh, it is closely tracking the labor market, right? That is one of the most important points to remember. Any signs of weakness in US employment, that is the rise of unemployment rate or decline in job growth, it can manifest into a full-blown recession. That is the fear of the market right now. The jobs data in US, raised these two concerns very recently. And this, I think, to my understanding, is one of the key driver of global volatility. And why is it important? Because of the presence of multiple geopolitical fault lines as of today. There are wars happening. There is upcoming US election. There is possibility that there could be another trade war. And plus you have very expensive valuations. So this is possibly a time where investors may not be able to digest a scenario where US growth slows down and corporate earnings comes down, right? And that can cause a reversal in expectation of the kind of returns that people are expecting. Although there is no way to know whether a recession will happen in US or not, but if the US labor market weakens, it is a cause of concern. And the point is how to track and make sense of all of this, right? So I have spoken about two or three things. So I'll tell you what is the crux of the argument, or maybe let me tell you what to look forward to. Okay. So first thing to look forward to is weakness in US labor market. Whenever you see data related to weakness occurring in US labor market, for example, non-farm payrolls data or weekly jobless claim going up, retail sales going down. These are some of the markers that markets will be very interested in, although most of them are short-term data and they may not amount to anything. A single data reading may not amount to anything, but over a next 3 to 4 months period, they will become crucial. Second and more important point to or data point to watch is the volatility index VIX. Recently, it went to as high as 65, largely maybe because, as I've said earlier, markets are very complacent globally, and this was maybe one of the symptoms of that complacency getting tested, where a lot of people then chased protection. They chased put options, and that led to a very large spike in VIX. But as long as VIX stays above 20, do not discount it. It could be a sign that markets expect or know something that we do not know, right? So watching that data becomes very, very critical. And it does appear that markets have a huge overhead resistance at the recent highs that US made. And uh, and it may see a plethora of change, to digest. As I said, a number of events are coming up. So the weight of evidence currently is tilted in favor of being cautious. And that is the overall view on what has happened over the last 1 week. My idea will be to, give it more time, give it and look at these data points more carefully before you take any decision. As I said, the weight of the evidence does appear that it will be prudent to be cautious. Next, we'll keep going and we'll talk about the four aspects that we initially spoke about, which is our report, which is DSP Netra. Uh, the first is the boom and bust cycle. Okay, and this slide highlights the non-linear nature of financial market returns. All of us sometimes believe that financial markets will keep delivering 12 to 15% or 10% kind of returns for a very long period of time. But when you look at this chart, which is there on your screen, you will see that returns, even in the most prosperous and better performing market, which is the US, they are very patchy. There are long periods of low or poor returns, and which are depicted in red bars here. As you can see, in the graphic, there are periods as long as 15 to 19 years of low or single digit returns, and many periods of very high returns, right? So the expectation that markets can deliver stable 10, 12% returns is possibly incorrect, right? And here we are talking about, as I said, the most prosperous nation in the world. If you compare other countries where economic growth hasn't been so steady, or earnings growth for companies hasn't been so steady, the results are even more poor, right? Uh, so the most important years of our own earning and our own investment may lie anywhere in these bars, right? We may start our investing journey when, for example, a 15-year poor period is just about beginning, and we don't have any control over these numbers, right? So this is pure luck, and currently what we are witnessing is a period of about 16 years of high returns in US, 12.5%, and similarly for India, 25-year period of good strong returns. Of course, you can break it up into various periods. The idea is that because it is impossible to know what will be the future return, we have only two markers. One is that when historical returns are very high, usually future returns could be lower. Okay. And this is something to think about very, very deeply. And therefore, the only antidote is to select sound businesses which are available at fair prices and not chase stories and narrative based speculative investments. So I think that is something which is under our control. And at this point in time, I believe that uh, focus on valuations becomes critical. And given that historically we are sitting on high returns in US, in India, it makes a lot more sense to be very, very quality and valuation conscious. So this was about the boom and bust cycle. We need to be careful that there is no single phase that will continue forever, neither booms nor bust. The next chart talks about valuations. As I told you, the next section will focus on valuations and the specific term that we've been using, the unsettling calm. So as we navigate the bullish waves of market, it's very imperative to sharpen our focus on valuations. And why is that? Because the COVID crash, which offered well-priced securities, at a time when we had a lot of bargains in the market, that now has dramatically shifted. Now we are witnessing prices soar, stock prices, which are driven by anticipation of very strong earnings growth, right? So we analyzed about 1,220 companies listed on BSE All Market Index, and what it has revealed is very, very stark data. It shows you that more than half of these 1,220 companies are trading above 40 times earnings. Okay, this includes companies which are loss making as well, which is visible on your screen. And this universe, which trades above 40 times, is very pricey. And there are very few companies which are available below 20 times earnings or lower, which means the universe of companies which are attractively priced is now much smaller. Okay. And if you dive deeper, you will find that a significant number of the stocks which are overly priced is possibly away from the large cap space into the mid, small, and micro cap space, and therefore they lack certain amount of margin of safety. So this is a slide which depicts and breaks the market, which is what we call the breadth of valuations, and it is not very favorable at this point in time. And we have created a margin of safety heat map, which I will now talk about. And if you look at your screen, this is a margin of safety heat map. the greener the heat map, this, for example, this section, it means more stocks are available cheap. More red means a large number of companies are expensive. So since the COVID bottom, the heat map has turned from green to red. It is now more red than it was earlier, and then it has been ever. That means the amount of red that you see on this graph is at its highest level in India's history. If you look at the data for last 20 years, although this chart is from 2010, if you go back even further, you will find that on a breadth basis, the market has not been so expensive, right, like what it is right now. And this contraction that you are seeing of cheaply priced stocks, or the green area in the graph, it signals a shift towards richer, more expensive valuations. And this, we think, is the reason which necessitates for us to focus on sound investment strategy where you are focused on valuations. And currently, one notable point is that right now, companies available below 3-time price to book multiple, 3-time price to book, are at an all-time low, which again tells you that it's not very easy to find bargains in this market, right? Which was what we said in the last slide. It is a breadth and historical depiction of the same data. The last slide which I showed you is a point data, and this is a flow data for the same set of companies, but given over a period of time. The next one, as I said, is on the unsettling calm. In the current bull market, India stands out with its remarkable consistency, and we haven't seen this kind of consistency before. And our analysis shows that days with 1% or more drop in major indices are fewer than during past bull runs. In fact, 2023 on a broader market basis for Nifty 500 had the least number of 1% plus declining days ever. If you go back to even 40 years, you will not find this data. And this trend has continued somewhat, although 2024 is slightly more volatile than it was, but still qualifies as one of the least volatile years on record. And this highlights the sort of a unsettling calm or complacency which has set in. And what does this tell us? What is the take or conclusion from this data? Markets are unprepared for a prolonged correction or for an unknown risk if it rears its head, right? So the market participants uh, could be unable to understand volatility spikes because they haven't, seen the kind of volatility which can shake their confidence. And why are they unprepared? Because A, valuations are high. Second, there is a widespread over ownership for equities domestically. And also, I think we have showcased in many other slides earlier that there is an unbridled speculation. For example, the share of derivatives volume that India now commands is very, very high. So these data points, clearly showcase that, there is a sort of unsettling calm. And similarly, another sign of unsettling calm is the reading we have highlighted from, past 3 months. And in July, we completed 52 months of consecutive positive close for Nifty TRI. It's a record. And similar records have been made in all other broader market indices and small and mid cap indices also. And to know the kind of extremity we are witnessing, please note that there is no other major index in the whole world to have ever recorded 52 or more months of positive consecutive closes without a 5% fall month over month. This is the only instance in data that we could highlight. The one which could come closer is a similar rally that Nasdaq saw in 1990s. Other than that, there is no historical precedent. What is the key takeaway? The lack of correction is possibly making investors learn a wrong lesson. And so in my conversation, I often hear investors say that Indian markets are immune to corrections because of many reasons. One, which is often given, is huge amount of domestic inflow, and a lot of money is waiting on the sideline. These are the two general answers. But this assumption that flows can cause higher returns or prevent market fall is a flawed assumption. Markets do not move on past flows. In fact, flows do not cause returns, they actually chase returns. And some of the subsequent slides that I will show you will showcase to you how whenever there are returns, there will be flows in that segment of the market and not the other way around. So there will be hardly any segment or part of the market where flows will come first and then returns will come. You will not see this happening in any market. It's an exception. So what is the right lesson to learn? So we believe that it is appropriate currently to understand that fragility has increased. And one sort of a mini trailer of global fragility was seen in Japan in early part of this week. And markets are now more vulnerable to unknown risks than before. And the reason, of course, is that we have seen price gains, we have seen valuation gains, and also over ownership. So these are the key takeaways and key learnings that we should take from this over ownership. The next part is, next slide is on how, a heat map on how India has changed color. So on the left hand side of your screen, you see a heat map which shows how volatility in India has become very low. So just about 10, 12 years ago, India was one of the least, or sorry, India was one of the most volatile indices in the world. And now it is one of the least volatile index in the world. And similarly, on a price to book basis, India has been consistently pricey. So when you look at this heat map, you would want uh, to be more aggressive and more positive on India when volatility is slightly higher, which means that there is some amount of fear in the market. At that point, prices will be cheaper and possibly the price to book multiple is lower. That is the time to be aggressive. Right now, we are not there. Right now, we are at the opposite end where valuations are slightly more expensive and there is a general sense of calmness and complacency in the market. So this is a depiction of, sort of telling you that this is the time where you are not being served full tosses, and therefore the better way to navigate this test match is to play defense. Uh, the next section is on large caps, and as I said during the starting of the presentation, that we will be focusing on large caps and the interplay between large cap and other parts of the market. So although the broader markets are expensive, large caps may provide the opportunity to hide, um, specifically the largest cap, which is the large 10 companies domestically. And so if you remember a few years ago in India, there was a huge buzz about this phrase called big becoming bigger. A lot of people were saying that by the virtue of being big, many companies will become bigger because they command profit pools, because their balance sheets are stronger, etc., etc. But since then, small and mid cap companies, if you look at this black line, it has outperformed. Black line has gone down, which means large caps have underperformed in India by a very wide margin, right? In fact, large cap stocks, the top 10 stocks are now priced at the lowest level relative to the all India market capitalization going back to data over 40 years, right? This chart is only for top 10 companies over the versus the top 500 companies. So if you compare it to the all listed universe, currently the top 10 companies are at its lowest level in over 40 years, right? So currently no one is talking about big becoming bigger anymore. And the reason is because the other part of the market, the small and mid caps have delivered very, very strong returns. In US, the story is completely opposite, right? In US, over the last 15 years, the top 10 companies have delivered one of the largest returns by a small cohort of companies ever given. And in fact, there is a very, very good paper written by Ray Dalio on this subject, which showcases data for last 120 years, showcasing how this cohort is unique. And it also tells you what happened to many of these cohorts in the last 120 years when they produce these kind of returns and achieve these weightages. So in US, the story has maybe already played out or is playing out, where big becoming bigger or larger companies delivered stellar results and returns. In India, it has not played out. Maybe we believe that the largest companies in India now offer a high margin of safety that is available to you in price, and also they are more attractively priced in terms of valuations, right? So in India now there is a concentrated index called the Nifty Top 10 Equal Weight Index, and the broader market has outperformed this strategy by a record amount over the last few years, and which has made it much more attractive, right? And I will now in the next slide tell you where is the flow of money going and how you should think about your flows on where you should focus. So, for example, if let's look at the large caps from the point of view of investor flows. So, take a look at this chart on your screen. The green bars here in this chart, all the green bars here show you the flows towards active mid and small cap funds or small and mid cap funds. The red bars are for large cap funds and the black bars are for thematic funds, right? As you can see, sectors and themes have received the largest share of flows in 2024, strong flows even in 23. Small and mid caps have also witnessed huge amount of inflows. In fact, over the last 6 years, only 1 out of 10 rupees of net inflows into active mutual fund has gone to large caps. 90 has gone to either small and mid caps or to thematic funds. And why is that money flowing towards this category? Largely because returns have been made in these two categories. So investors are chasing these categories largely looking at the past data, and therefore the flow has significantly improved. When you look at the flows toward large caps, they are negligible in comparison to the overall market cap that they command, in comparison to almost 35% of free cash flow that they make domestically, and almost 68 to 70% of market capitalization that they contribute to. When you compare those numbers, these inflows toward large caps are minuscule. And we believe that this is one of the most important messages from for large caps. At this time, we think it's not prudent to follow the consensus flow of money, which is going towards thematics and mid and small cap. By virtue of being ignored, large cap space, we think offers relatively better, and the operative word is relative here. They offer better place to invest at this point in time. Another depiction, when you compare large caps to mid and small caps, you look at this chart and it talks about the momentum factor for small and mid caps over large caps. So the upper panel in this chart will shows you that large caps are priced cheaper versus the rest of the market. The red and black line are for small cap and mid cap on this chart. And it is at one of the highest levels that we've seen, right? Close to all-time high. For mid-cap, it is at all-time high. For small cap, it is at the second highest level, which means that small and mid-cap relative to large caps are at an all-time high. Even on absolute terms, they are at an all-time high. But at this all-time high, the momentum for mid and small cap has now started to slow down, which means that a 12-month rolling alpha of small and mid cap indices over Sensex is now turning lower, right? And this is the first sign that probably the uh, momentum, which was favoring smaller companies over larger companies, has already begun to turn at a point where we are at the all-time high. And the main point is large cap underperformance because of strong momentum for small and mid cap stocks is turning. And this turn is happening from a level which is, we've never seen this level before, close to a lifetime high. And therefore, we think that this is the right time to prefer large caps. This completes the three important portions that we wanted to talk about. And now we'll talk about the last and final leg, which is very, very critical and which will offer a number of insights to you, relating to the interplay between India's capex and consumption cycle. I will remind all the viewers there is a Q&A button on the webinar. You can press it and type your questions. At the end, we'll take those questions. So let's talk about the interplay between capex and consumption cycle. So one critical point to note: India's growth post COVID has been driven largely by a strong investment cycle. We have showcased a large number of data rich insights in on this cycle in our past and previous versions of DSP Netra. Specifically, you should go and check out our July 24 version, which talks in detail about how this expenditure happened and in which areas. Now, since investments and capex has been the backbone of the current rally, stocks in this universe have rallied and reached valuations which are similar or higher to those seen in the noughties. Noughties are the years between 2000 2008. Specifically, we are talking about the years 2003 to 11, where the biggest bull market in India took place, and it was largely driven by the capex cycle. And today there are numerous comparisons which are made between 2003-11 cycle and the cycle that we are witnessing as of now. So one look at the table will tell you that these two cycles are different, right? In 2003 to 11 cycle, which is the top end of the chart, which is the top table, you will see that the central government capex grew at about 10% CAGR, although other private capex indicators were growing at 20% plus or even higher over a 8-year period. And the cycle was exceedingly driven by private investments, not by government investments, right? It may have started with government investments and then it got passed on to the private space. The current cycle, as of now, which is already almost 5 years old, is completely driven by government expenditure, and private capex is yet to make a meaningful contribution. In fact, most of the indicators that we track currently continue to show that private capex is still in its infancy. It has not picked up as much steam as it should have, given the kind of valuations this sector is commanding as of now. And why is that the case? And maybe let me highlight one more very important critical data point to you. If you look at industrials, capital goods, and all other capex related companies and look at the growth in their net income or their PAT, and then plot the free cash flows that these companies are making, both are rising commensurately, which is a great outcome for investors, and therefore these stocks have delivered extraordinary returns. But from a capex cycle standpoint, higher free cash flow continuously, even after 5 years, when you are making a lot of profits and have clean balance sheets, highlights one important missing ingredient, which is addition of very high gross block, which means that these companies are not putting in as much capacity as they can given the free cash flow they are making right now. It's a great outcome for investors, but it sabotages future growth for the economy and also for some of these companies, because eventually their volume growth will decline. So what is the conclusion? This cycle so far is driven by government capex. We don't have a clue whether private capex will make a comeback or not, although the conducive conditions for the private sector to come back and do capex are already present. There is very strong balance sheet support. There is also availability of credit, and the ability of the financial system to lend is also present. Then what is missing? The missing piece of the puzzle is the consumption cycle. So there is a possibility, and this is our own conjecture or hypothesis, that in absence of a very strong consumption cycle, businesses are not able to visualize or see growth rates strong enough for them to do additional capex. Okay. So now we look at 4 or 5 slides, which will talk about the capex cycle. And we will go in a Matryoshka doll flavor, going from very long term to recent to immediate trends. So when you look at the chart on your screen, it depicts how India's consumption expenditure or the consumer market has grown in India. And please remember that consumption in India accounts for 60% of our economy. So this is the, sort of the, big daddy or the mainstay of India's economy, which is the consumption part of the economy. So the chart on your screen, it depicts the stellar rise in India's consumption expenditure. India is now the fourth largest consumer market in the world and will likely be bigger than Germany in the next 2 to 3 years. And it has also shown the second fastest growth rate over the last 30 years, compounding at 7.2%. The faster one was China, compounding at 11.7, and India being the fastest. US continues to be the highest and the most largest consumer market in the world. This means that our long-term consumption growth is at 7.2% CAGR over the last 33 years. And it also means, which is the most important conclusion from this slide, that domestic and global businesses cannot and should not ignore the Indian market because it remains very large and continues to grow at a sizable CAGR, right? Now, same data, let's look at it for the last few years. When you look at this data, you will note that in the last 6 to 7 years, the consumption cycle has started to slow down. It has slackened, right? And the graphic that you see on your screen, it will show you that the growth rate is now just below 5%. The growth rate that I showed you in the last slide was 7.2%. This means that the strong phase of consumption growth has slackened over the last 6 to 7 years. And notice that it was slowing down even before COVID, right? The numbers had started to decline. It's not only a COVID phenomena. The decline had set in earlier also. So one case that is currently made out is that because economy is driven by investments and therefore the share of capex is declining just like it declined in the 2003 to 11 cycle, and therefore everything is all right. But when you look at the growth rate which happened during the noughties, which is the 2003 to 11 period, the consumption cycle was also growing between 8 to 10%, which is a very strong growth rate versus it growing at 4 to 5% now. And therefore, um, over the last 6 to 7 years, this stellar consumption part of the economy, which has been the mainstay of India's growth, has started to somewhat slow down. And what has taken over sort of investments that is driven by government capex. So this is the story that we've seen until now. Now we look at very short-term data. This is the shortest term data available to us. And it is showing that there are some signs that recovery is happening. Okay. Wage grades are recovering in rural India. Two-wheeler demand, again, an indicator of non-premium mass market segment, has started to pick up. FMCG volumes have started to show some increase. We highlighted this back in March, where we said that FMCG could be a sector which could make a comeback, and there are more evidence that we are witnessing that possibly there is a comeback being made. Work demanded under Manrega is coming down. Again, a sign that some amount of distress is dissipating from mass market. So these are some shorter term trend indicating that there may be some green shoots for consumption. But let me now highlight two risks to this hypothesis, which, as any skeptical investor, you should keep in mind. First is that the consumption cycle is heavily skewed in the current cycle. So if you look at the chart on your screen, this cycle on the upper end shows you the sale of SUVs, two-wheeler, and small cars. And the left-hand side lines are for 2003 to 11 cycle. Note that all the three categories grew in a widespread sort of a prosperity boom. But in the current uptrend, only SUVs and premium segment, luxury segment vehicle has seen a growth, right? Which is very unlike the previous cycle. And similarly, when you look at the real estate sector, and sort of housing sector sales, high ticket size houses, the premium and luxury segment, it is growing, and the growth is much more stronger than the affordable and low cost segment. This highlights that there is sort of a skewness or a K-shaped recovery which has taken hold in this capex cycle. Now, what does this K-shaped recovery mean? This is, one of my favorite depictions to highlight what I wanted to say in the last 3 to 4 slides. That one K-shaped recovery is a risk to consumption. Okay, so when you look at the left-hand side chart, it shows you two segments. First, the upper one, which shows you government revenue growth. Okay, so in the 2003 to 8 cycle, government revenues grew at a very fast rate. Tax revenues were very, very strong. At the same time, the formal economy was doing very well. Okay, which means that taxes were growing, formal economy was doing well. We'll cut to the current cycle. taxes are not growing as strongly, although the formal economy is doing very, very well, which I showed you in the last slide. The premium luxury metro city segment, they are doing very well, which means that the lower end of the market or mass market or non-premium market is not doing as well. So there is this K-shaped or skewness in consumption recovery, which is not playing out properly in rest of the market other than the premium market. Okay. And similarly, all the tax increase that the government has got hasn't been spent on reviving the part of the economy which is not doing well. So this is the risk to the overall hypothesis that the K-shaped recovery might not resolve by the lower end coming higher and catching up with the premium segment, but by both converging lower, which means that slight recovery in the mass market segment and a large fall in the premium market segment. And why do I say that? Those of you who attended the July webinar or read our July edition of DSP Netra, we showcased a slide which shows you wages and salaries growth for organized tier one employees through the BSE 500 numbers. Those numbers have also started to slow down, which tells you that the premium segment of the consumption cycle could also come under some sort of a slowdown from the stellar growth that we've seen, right? So, to put the argument together on capex and on consumption, going back to the interplay between consumption and capex cycle, if the consumption cycle remains weak or patchy, the possibility of private capex to take the baton from government expenditure becomes quite low. And this can threaten the growth for domestic economy that we've seen has been very steady. And therefore, investors should analyze the valuations that we are paying for specifically for the capex part of the economy. The reason being that consumption stocks have commanded much lower valuations in the current cycle, specifically the staples. So they do not have the kind of froth that the other part of the market has. And therefore, the growth rate that we are seeing in the economy is contingent on a recovery in the consumption cycle, more so than the capex cycle. So the investor focus has to be greatly towards how quickly and steadily consumption improves in India. So this brings me to an end of this series of DSP Netra, and this is the last depiction of how behaviorally we think about a good investing opportunity. It needs to have three combinations: better valuations, it should be under-owned, and the underlying businesses should be durable. If you have these three things going, then most likely the investment will turn out to be much more favorable.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.